If you're still losing trades after learning candlestick patterns, you're studying them the wrong way. Candles aren't just shapes, they tell the story of the battle between buyers and sellers. In this video, I'll show you how to read that story like a professional trade. The first reading of the candlestick chart is one of our 4 episodes. The first episode is about the meaning of the candlestick chart. What is it, and what does each column tell us? If you have any trading topics you'd like to discuss, just press 2 inches, comment, I'll clear things up for you. The second episode is about reading the candlestick chart without remembering, and the third and the fourth will be different types of graph, which will follow in the next clip. Let's get started. What is a graph? A graph is a type of graph. It has the shape of a scale. The scale consists of the part that is the scale, which is the part that is thick. And there will be a scale, up and down, both top and bottom. The scale is called the body. We call it wick. Now, there are many types of wick, right? It will be like this, with a little wick and a long wick. Or there will be a lot of wick and only a little wick on one side. In some cases, there may not be any wick, but there is almost only one wick. This wick graph will tell you the opening price of the day, the closing price of the day, the highest price, and the lowest price, all in one. What's more important is that we can tell the investment action, what the buyer wants to do, what the seller wants to do, and we can also predict the trend of the market in the future. Let me give you an example. The gold bar in the market has risen. The market opened in the morning at the price of $9, and the closed market in the evening at the price of $13. You will see that today the market is rising, starting at $9 and ending at $13. Now, if we drag the line from the opening price and then drag the line to the closing price, we will create a trend. The trend is to open and close. Now, when it opens at a low price and closes at a high price, so there will be a green color instead of the price. Now, the main filling. The filling is the lowest price and the highest price. The lowest price is $8, which is the filling at the bottom, called low. As for the highest price of the day, or high, it will be the filling on the top. Look at another example. The price opens at $11, and the closing price is $12, which is very close. Therefore, the size of the diamond is short, because the opening and closing are close. Open $11 and close $12, but the lowest price and the highest price are quite different. The lowest price is down to $8. It will be a long diamond inside. Down below is the low side. The highest price is $13. It's not very long, but it's short at the top. Now let's look at the example of the lower leg. The lower leg will go back. That is, open high and close low. Open high when opening, open at 13, and when closing, close at 10. Now we will create a diamond, or the diamond rod will open and close. But because it opens at the top and closes at the bottom, so we use the symbol as a color, which is red. On the other hand, the market has a downturn. As for the inside, the top and bottom are the same. The bottom will be the lowest price of that day, and the inside at the top will be the highest price of that day. Now, to sum up a little bit, the uptrend will be green. The open price will be at the bottom, and the closing price will be at the top. This indicates that that day the stock rose. And if it is a lower leg, it will be red. Open at the top, open high, and close at the bottom, which is at the bottom. Now it will have a cool name. The upper leg is called bullish candle. Blue or bullish candle is what we like to call it. As for the lower leg, it'll be called bearish or bear. I would like to take you all to see the real thing. The example you see here is from the TradingView program. One bar represents the price of one day. Therefore, in each graph, the left and right sides will represent the period of about 1 month. But we can see that the left and right sides of the graph are not the same. On the left side, the graph is quite consistent. It will be continuous. On the right side, you will see that there is a jump. It looks like it will be missing and not continuous. Why is that? Because the example I brought is from 2 different markets. On the left-hand side is the cryptocurrency market. This market opens 24 hours, which means that the end of the day will be a new day immediately. Therefore, prices continue to fluctuate. According to the time of Thailand, the new stock will start at 7 a.m. Therefore, suppose this stock starts at 7 a.m. and then at 6:59 a.m. of the next day, the stock will end. And then at 7 a.m., the new stock will continue to rise. On the right side is the stock market. The stock market will have time to open as usual, that is, open in the morning and close in the evening, which will depend on the market of that country. How many hours will they open and close? The new trend will start when the market opens, and when the market closes, there may be several hours of time, which is at night. Nothing happens. There is no buying and selling. But the economy continues to progress. Therefore, when it rises, it may have an opening that can jump. Let me take you to see an example, like zoom in. Crypto market. Suppose the bottom is the 1st, 2nd, 3rd, and 12th days. For example, the 2nd day. The 2nd day closes the market at the price at the white line. It will open the new market on the 3rd day immediately because there is no time to stop. Look at the next example of the 6th day. The 6th day, the market is closed at the top, the market rises. Open the new day on the 7th day, it is in the same price. The 11th is the same. Close the market at the top and open the market at the 12th in the same price. The Forex market, if we look at the example here, the 6th and the 7th. The 6th is closed at the top, but what happened? There was a price jump, right? On the 7th, the price jumped. Why is that? This is not difficult to explain. That is, in the evening, the market is closed. But there may be good news. For example, the company said that the results this year are very good. There is news. Therefore, people think that the stock must go up. The price must go up. When the new day opens, people will sell at a higher price. Probably no one wants to sell at a low price because the news is good, right? Now people buy. If they want to buy, they have to pay more to get this Forex. On the other hand, let's look at the 9th and 10th. On the 9th, the price closed the market very well, but I don't know what happened that night. There may be rumors that some countries do not accept this kind of product anymore. If they don't accept it, they can't sell it to that country, so the price fell. When the market opened the next day, the price fell because people knew the news at night. Therefore, the Forex market will be different from crypto here. Crypto will continue. As for the Forex market, there will be a period when we can't do anything. Just sit and watch and expect what will happen on the day it goes up. Now, if we look at a lot of images, we will see that there are many types of candlestick graphs. Some of them are here. There is no candlestick, and there is a long candlestick. Some have a lot of candlestick. There are only a little bit of honey. Some of them have a little bit of honey, but the filling is very long. And some of them, on the right side, there is no honey. There is only honey. And there is only honey on the bottom. There is no honey on the top. Each one has its own meaning. If we can explain the meaning of each one, we will understand the market better. What does each sugarcane tell us? Let's take a look. Let me give you an example of this bar. This bar is a rising market. It opens at the bottom and closes at the top. That is, there is a trend going up all day. Let me give you an example of a graph. It opens at the yellow point and rises a little bit. But in general, the trend is rising and will end the day at the top. This kind of graph will be seen a lot. We call it a bullish candle. That is, there is more demand than supply. There are people who want to buy more than people who want to sell. When there are people who want to buy a lot, they have to fight to buy. And ask what to do if you want that product. You have to offer a higher price, right? It's limited, but we want to get it and we have to compete. We have to pay at the end. When we pay at a higher price, the price will go up. This is the market going up. Another one will be the opposite. It's a market going down. Open at the top price and close at the lower price. Now we call it bearish candle, which means there is less demand than supply. There are fewer people who want to buy, but there are more people who want to sell. So if everyone wants to sell but can't sell, what should we do? We have to cut the price, right? We have to compete to reduce the price. Therefore, those who sell later have to sell at a reasonable price. But if you want to sell, you have to accept to reduce the price. Therefore, the overall price of the market will drop. Now these two are quite easy because we will see each other often. If you have any trading topics you'd like to discuss, just press 2 inches. Comment, I'll clear things up for you.